Hey, folks, welcome to Market Intraday Analysis by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. Today, Friday, July 30th, 2010. Well, last trading day of the month of July comes to a close here. We have about 2 hours, a little less than 2 hours left in the trading day, and the markets are slightly to the downside. Now, we gapped down in a huge manner this morning on the back of some ugly GDP numbers. Now, GDP is a little more complicated than just saying they were ugly numbers. I want to go in depth here because I do believe it's important to understand the reason for the gap down. Then we're going to discuss exactly what happened as the markets surged back to the upside and actually went positive at one point before pulling slightly lower here on the day. Now let's start with that GDP. And again, you can see the spiders are trading down off the highs of the day here. Here's your gap down. And again, look at the surge that we had to the upside. You came right into this blue trend line. Look, if you connect the blue trend line from yesterday's high to the second pivot high and connect it all the way down, you can see the market could never get above that blue sloping trend line, ultimately coming back down. And now you're seeing a little bit of a bounce back up. Volume is extremely light here on the afternoon session on this Friday, as is to be expected. Remember, Fridays in the summer, most traders are taking off early and heading to the beach, heading to the Jersey Shore or the Hamptons. Now, a couple things to go over. Let's cover that GDP number. The GDP was reported at 2.4%. Now, that actually is in line with estimates. People had generally thought that 2.5% right in there. So it wasn't a bad number itself. But the key came out when last quarter's, which was quarter number one, this was quarter number two reported today, quarter number one was revised higher from 2.7 to 3.7%. Now, you might be sitting there and saying to yourself, okay, well, revising GDP up, isn't that a good thing? So why did the markets tank? I don't understand. Well, it actually is a good thing for last quarter, but the problem is the disparity between this quarter and last quarter grew hugely. I mean, you just had a huge development here where the difference in GDP, originally it was 2.7% for quarter one, and then today was reported at 2.4. That's a very small disparity, 0.3 disparity between the GDP of last quarter and this quarter. Now, based on the revision, you have a huge change. There's a huge gap between last quarter and this quarter, and what that does is make many people, and what it did this morning is make many people believe that the GDP or the markets or the economy is in a major slowdown event right now. And again, you can see how that is what the drawn conclusion was. When you have GDP at 3.7% now, which was the revised Q1, and GDP at 2.4 for Q2, there's a huge gap there. That tells us, and that told many traders this morning, that maybe we have a massive slowdown in the economy again, double-dip recession in progress, and that ultimately could lead to a obviously major issue for earnings going forward, for the economy, for anything else going on that could be affected, including all these economic reports and earnings and possibly Europe and defaults and all that stuff is now coming into phase. So that was the key for this morning's GDP report and why you saw the markets really collapse on that number. Now, having said that, we got more economic news, and the more economic news really helped the markets recover here as we got the market to open and the market gap down to a low pivot of 108.98, which just so happens to be an even number play for those of you that are interested, the even number play coming out there. We got BP to come out, and BP came out with news, British Petroleum here, and we'll punch up the chart for you. BP came out with news that they developed or they put into effect a $100 million unemployment workers fund for rig workers in the Gulf. Now, that's huge, obviously. So that gave the markets a little bit of a bounce right there. That's money flowing to that area, obviously will help the economy down in that area as that money flows to unemployed rig workers. In addition, at the same time as that news came out, Chicago PMI came out at 62.3. Analysts had expected a range of 58.5 to 56.3, so substantially higher at 62.3 than what the analysts had expected. The market started to rally on that, squeeze higher off of the BP news and the Chicago PMI. And again, you can see right here, here's your first candle. Second candle is a 10-minute candle. Therefore, it covers that 9:45 a.m. level where that news came out, and you can see the major move up. Now, as we came up, we squeezed higher. We came into the low pivot from yesterday. That began to stall. You can see the tail here. We pulled back. Then we got the 10 o'clock time frame, 9:55 time frame. At 9:55 a.m., University of Michigan sentiment came out higher than expected as well at 67.8. That just added the fuel to the fire. And again, markets surged higher. The squeeze was on. Shorts were having to cover. That's forced buying. All of a sudden, went crazy. Market rallied all the way from 109 back to a high, turning positive at 110.50 to 110.64. So you basically had a $1.50 gain in $1.50, $1.60 gain in the SPY in a matter of less than 1 hour. Once the markets reach this blue trend line, enough said. You guys should all be seeing this, how clear this is. Connect the high pivot from yesterday, connect it to this pivot here, and just draw the line straight down. And you can see the markets are having a lot of trouble here getting above this line. In fact, the rally that's taking place right now, the last two candles, the markets are shooting up. Look at where we are again. Right at this blue line. Now, if you get above this blue line, ultimately I do think there's a chance that you retest the high of the day and maybe even go up a little bit higher just on light volume aspects of a Friday afternoon. Remember, folks, for those of you that have been following our videos or even Research Center members or Intraday Stock Chat members, and really everyone out there should be at least a Research Center member based on the availability of the massive money-making info in that Research Center, you should understand that on Fridays of light volume, especially in the summer, it's very unlikely that they want to close this market to the downside. And that's actually what I portray as the more psychological aspect. You had people panicking this morning on some of this news. The PPT, Plunge Protection Team, or some other players out there, remember, there's not a lot of effort put into pushing this market down. The whole idea is to keep the market floating up, especially on a Friday. Why? Because the average retail investor is going to be trying to go out and buy things over the weekend. That's what the goal is. That's what the government wants. The government wants you to go out and spend on the weekend so you help the economy. That's when everyone generally spends their money for the week. You're going to go out and buy a new TV. You're going to go out and buy a new car. You're going to go out and buy a new couch. That's done on the weekend. It's not generally done on a Wednesday. All right, so in doing so, would it help that mentality if the markets dropped 500 points on a Friday? No, probably not. You'd say, wait a minute, I maybe can't afford this TV right now. No, maybe I can't afford this couch. But what happens if you push the markets and close them flat on the day? Well, all of a sudden, you go out and say, all right, well, the market, we're fine. There's no major issue here. I'll go out and buy that TV. All right, or even positive, slightly positive. So in my analysis in general, especially in the summer months of light volume when the manipulation in the markets can be more true, you can see it more often, that's generally what will happen on a Friday. You'll very often, unless there's some major negative headwinds and heavy volume, you'll see that market end flat on the day. And today it looks like that's the case. The gap down right here, reversal to the upside. In addition, for those of you that are Research Center members, take a look at the trend line that was hit today, and I want you to see this because it is an amazing little feat. If you go back, and these are levels that I've had on the charts for weeks now, take this first blue line, connect it through these lows, and connect it through this pivot low and this pivot low. Look at the low of today. Right into that level, and that's where the rally started. This was a major trend line, and I've said for quite some time that you generally would have a neutral to upside longer-term bias, meaning when we turned and had our turn date back here, and we nailed that turn date perfectly, by the way, for the upside, and if you break these two slanted trend lines right here, this one and this one, to the downside, then all of a sudden you should have some more downside in the market all the way back down. But as long as those hold up, you can look for plays off every trend line to the upside. Nice little swing there. And again, spiders are having a huge surge here. Look at this. We are really right back on the intraday blue trend line. Watch that. You get above this, remember, good chance of you going into this upper level here or possibly up to the 200 in the afternoon session. All right, folks, my expectations for the rest of the day, the markets to close flat. I want you to make sure you join the Research Center. We're going to be putting out more plays for next week. This was another profitable week. We just continue to stack them back to back in regards to the calls in the, whether it was on gold, beautiful calls on gold, beautiful calls on the dollar. SDS made money this week on that. There's plenty of plays to go around and more plays to come next week in the Research Center and in the Intraday Stock Chat. Take care, folks. Have a great weekend. I'll talk to you then. Take care.